The Dow hitting 50,000 sounds fantastic, right? But at the same time, we are staring down the barrel of potential 18% tariffs on goods from key trade partners. How can these two realities coexist? This is the great K-shaped paradox of our current economy, where one part is soaring to new heights while another is being pulled down. Today, we are going to dissect this divergence, understand the forces driving each path, and figure out what it means for your wallet and your future. Forget the headlines. We are diving deep into the real numbers and trends that truly matter. Let's start with the up curve, the one everyone loves to talk about. The stock market's incredible rally isn't happening in a vacuum. A massive driver is the artificial intelligence capital expenditure boom. We are talking about an estimated $200 billion being poured into AI infrastructure this year alone by just a handful of tech giants. This spending spree creates a ripple effect, boosting profits and stock prices for a whole ecosystem of companies, from chipmakers to software developers. Then there's the wealth effect. It's a powerful psychological and economic force. When people's investment portfolios swell, they feel richer and are more inclined to spend. But here's the crucial detail. The top 10% of households in the US own a staggering 93% of all stocks. So, this wealth effect is highly concentrated, fueling luxury spending and high-end markets, but leaving many others behind. And finally, we have the persistent hope for interest rate cuts. The market has been pricing in a more accommodative stance from the Federal Reserve for months. The very prospect of cheaper borrowing costs makes future corporate earnings look more attractive and encourages investors to take on more risk, pushing stock valuations even higher. These three factors, AI investment, a concentrated wealth effect, and rate cut optimism, are the primary engines powering the upward-sloping part of our K-shaped economy. Now, let's flip the coin and look at the down curve. This is the reality for the majority of people and businesses. We hear talk of a major new trade deal between India and the US, which sounds positive. But when you dig into the specifics, the deal apparently sets a floor for tariffs at around 18%. That's not a reduction. It's a baseline that could make a huge range of imported goods more expensive. This potential tariff pressure comes at a time when we are already seeing stickiness in core goods inflation. While some prices have come down from their peaks, the cost of many everyday items remains stubbornly high. Think about it in simple terms. A pair of running shoes that cost you $100 a couple of years ago might now be priced at $118. That 18% increase isn't just a number on a spreadsheet. It's a real hit to your purchasing power. This is the side of the economy where wages aren't keeping up with costs, and financial pressure is mounting for the average household. The down curve is defined by these rising costs, trade friction, and the everyday struggle to make ends meet. So, we have this stark divide. How do we navigate it? Interestingly, a new economic frontier is emerging that might offer a way out, or at least a different path. It's what some are calling the orange economy. This isn't about agriculture. It's about creativity, arts, and intellectual property. Think animation, visual effects, gaming, and comics, the AVGC sector. This creative economy is exploding. India, for example, is projected to need 2 million skilled professionals in this sector by 2030 to meet global demand. The beauty of the orange economy is that it largely bypasses the physical world's problems. You can't put an 18% tariff on a digital file or a creative idea being sent across the internet. This is a world built on digital intellectual property, not physical shipping containers. It represents a fundamental shift in where value is created, moving from tangible goods, which are subject to tariffs and supply chain issues, to intangible assets that can travel globally at the speed of light. This isn't just a niche market. It's a major economic transformation that savvy individuals and even entire nations are starting to leverage. Given this complex and divided economic landscape, what's a practical survival strategy? How do you protect yourself and potentially even thrive? First, let's talk about tangible assets. In an environment where the value of currency is being questioned and financial markets feel disconnected from reality, pivoting a portion of your portfolio to gold can be a prudent move. Gold has historically served as a hedge against inflation and economic uncertainty. It's a store of value that exists outside the traditional financial system. Second, and this is crucial, you must aggressively avoid consumer leverage. With interest rates still high and the cost of goods rising, taking on high-interest debt for depreciating assets is a trap. Credit card debt, car loans, these things will eat away at your financial foundation when your real-world costs are climbing. Focus on paying down debt and living within your means. Finally, be aware of a concept called fiscal drag. This happens when inflation and wage growth push you into a higher tax bracket, even if your real purchasing power hasn't actually increased. Your nominal income goes up, so you pay more in taxes, but you're not actually any better off. It's a hidden tax that quietly erodes your wealth. Understanding this dynamic is the first step to mitigating its effects through smart financial planning. These 3 steps, considering gold, avoiding debt, and understanding fiscal drag, form a defensive strategy to navigate the downward pressures of the K-shaped economy. So, as we wrap this up, it's clear we are living in an age of economic contradictions. We see vanity metrics like the Dow Jones hitting record highs, celebrated on the news every night. But this masks the underlying reality for millions of people who are grappling with their own personal inflation rate, which is often much higher than the official numbers suggest. The key takeaway is to look past the headline numbers and focus on your own economic reality. The disconnect between the soaring financial markets and the struggling real economy is the defining challenge of our time. Don't be mesmerized by the up curve if your personal experience is on the down curve. It's time to get real about your finances, build a defensive strategy, and focus on what truly impacts your household. I want you to calculate your own personal inflation rate. Track your key expenses, your food, your gas, your housing, and see how much they've really gone up over the past year. That's the number that matters. Thanks for watching, and don't forget to follow for more insights into the real economy.